Keith Black, there's a lot of talk about liquid alternative funds right now. A lot of them are hitting the market. So what should an individual investor look for in a liquid alternative fund?
First, we need to define what liquid alternative funds are. So they're marketed as mutual funds, but they're not long-only stock and bond funds. And so you're going to find a number of different asset classes in a liquid alternative fund. It could be a hedge fund or a managed futures-like product, could be commodities, could be volatility, but the key is it's going to be different than your long-only stock and bond fund.
Well, you can only own so many funds in your portfolio, so how do you know whether or not you need an event-driven fund or a global macro fund or a long-short credit fund? So how do you kind of winnow that down?
So what you'd like to do is find something ideally that's different than the funds that are already in your portfolio. So we're going to look at a statistical measure called correlation. And so we're going to look for the funds that are going to have the lowest correlation to the funds that are already in your portfolio. Something such as volatility funds or managed futures or commodities. They're completely different asset classes than stocks and bonds. And so that's going to be where you're going to find the best correlation benefit. It's going to bring a diversification, and ideally the funds in your portfolio are going to hold up or even have a positive performance when your stocks and bonds are falling down.
A lot of these funds are fairly new, so you're not getting 3-year track records. So how do you choose the best fund without that historical information?
That's a little bit of a problem because we've been in a 5-6 year bull market, and it's easy to make money in a bull market. So we have to understand what the risk parameters are as well. So a lot of these funds, especially the hedge fund-like vehicles, are offered by hedge fund managers. So even though they have a short track record on the mutual fund side, they might have a longer track record on the hedge fund side. So look to the hedge fund managers and see if they have a longer track record, one that goes beyond 2008, so we could see what the performance was in that market environment. But we also have to think, how is the hedge fund different than the mutual fund? Because there's rules by the Investment Company Act of 1940 that limit the degree of leverage, that limit the degree of concentration and liquidity risk. And if the hedge fund manager has a strategy that's completely different than is allowed in a mutual fund, then that track record is not going to be as close as we'd like.
And you mentioned that the addition of a liquid alternative fund can help lower the correlation in someone's portfolio. How do you know if your portfolio is too one-directional?
So I did a study of the typical portfolio might be 60% in equities and 40% in bonds. So I took 10% out of the equities, 10% out of the bonds, and put that 10% in long-short equity and 10% in managed futures. So the stock and bond portfolio that might be fully invested long only had a 32% drawdown in 2008. But the portfolio that had just 20% in long-short equity and managed futures had a drawdown of only 20%. Even though the performance since 2008 is just 0.5% different each year.
All right, and then finally, what should investors avoid when it comes to liquid alts? Because they're being bombarded by a lot of information right now. Their advisors are saying, you need one, you need one. So what type of things should they push back on?
Certainly you want to look at the fee burden. The average fee of a liquid alts fund is 1.5%, which is clearly better than 2 and 20 in a hedge fund. But you need to look at what that all-in fee burden and expense ratio is. And just because someone says it's liquid alts doesn't mean it is, right? And so if somebody calls you with an infrastructure stock fund or a commodity stock fund, you know what that is? That's a sector fund, right? And we've been investing in those in a long time. And in your S&P 500 index fund, you already have commodity stocks and infrastructure stocks and so on. So look to the diversification and look for things that are clearly different than what's in your portfolio.
Thanks a lot, Keith.
Thank you.
Thank you for watching The Street.